great question. The European equity market is very sensitive to inflation. That's because we have 20% banks and insurance, 20% financials, 20% energy, commodity and material stocks. Therefore, when inflation rises, European equities do well. Inflation in the Eurozone has averaged around about 1.4% over the long term, and currently core inflation is sat at just over 1%, while headline inflation, if we include energy prices and food prices, is above the 1.5% level. So this is low relative to history, and it's low relative to the US because core inflation in the US is now above 2% and likely to rise further. So I think the ECB is mindful of this fact, and what's holding back inflation in Europe is the labour markets, wage growth. We've seen very benign wage pressure, which means that this is not allowing core inflation to rise. But I think the labour markets in Europe are now clearing. We're starting to see evidence of significant labour shortages. And whenever we've seen these shortages, core inflation tends to follow through. So the ECB, I believe, can see this, and we're starting to see a much more hawkish rhetoric from the central bank and from a number of finance ministers, not just Germany, but also in France. So I suspect that the ECB will be looking to really lower the QE from the 30 billion target it has up to the end of September. And as the French finance minister said, the market should be ready to perhaps expect a rate hike not soon after that. So it looks as if the evidence is mounting for higher inflation and higher bond yields. And again, that's very good for European equities generally, European financials specifically, and also European energy and commodity companies. So exactly that. So we've been building this portfolio for just such an environment. Higher inflation, higher bond yields and higher volatility. So we have an overweight in energy of just under 5% relative to the benchmark, and we have an overweight in financials, but only a small one. It's still 21% of the portfolio is in financials, which is over a fifth. And so we're mindful that you can have too much of a good thing. The other overweight that we have is healthcare, where we have an 8% overweight, not just in the drug stocks like Sanofi, Bayer and Merck, but also in the biotechs, stocks like Morphosis and Livanova, and medical equipment stocks like Fresenius. So, we can see growth in the healthcare sector over and above that of earnings growth in the market, and we are likely to recoup some of that return that we've been penciling in terms of the earnings growth that we have in our model. So we've been looking at the standard deviation and the beta of the portfolio, and we've been looking to target downside capture. So when volatility rises, what you want to do is to lower the downside capture relative to the index. And currently, the fund has a beta of below 1 times. It has a standard deviation nearly 10% below the index, and our downside capture ratio is below 80% of the index as well. So we welcome volatility. It's typical of this late cycle part of the market, and we have built a portfolio in expectation of this. And bearing in mind, when we go back at previous cycles, European equities always stage a late cycle rally, always outperform in the final third of any recovery. So we've built a portfolio with that in mind, with exposure to cyclicality, but also with one eye on the downside.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。